Welcome to the Financial Conversation with Doniel. My name is Doniel Lovely. I'll be your host today. So, guys, welcome to another episode. In this episode, we actually want to build off of the foundation of financial literacy, and we want to talk about things that people have a lot of questions about. I get a lot of times my clients talk about this over and over again. And one of the things that we mostly talk about is our personal credit, right? How come that we were never taught personal finance and personal credit in any form or fashion of our school or of our education system? You think it's an accident or an incident that has happened. It was done deliberately, right? Because if you understood those phenomena, then you would not want to go and work for the factories, the manufacturer, the people that are actually offering like labor works, jobs, things like that, because you now know how to leverage yourself and then be able to make money from that perspective. So what we want to actually have a conversation about today is, what is credit? How does it work? What is the factors of it? And how that we can actually use it to then actually build legacy for our family, right? So guys, let's get into it. All right, so first things first, right? The credit reporting, the credit score is not something that's built in somebody's, drawer or cabinet at the office, like you have a personal file or something like that, right? It's basically a data points driven system based on the time and period that you pull a report. So for instance, if you have a 680 today and something happens tonight or tomorrow and you try to pull it tomorrow, it would actually change up or down based on that data point system. So what does that mean? That means is a different type of data point system that determines at any random time where your credit score falls. So for instance, say I'm actually trying to go get a house or a car, right? And I pulled my credit myself. I looked at, one of the free sites. I'm not going to say their name, but you go look at one of the free sites, and then what you find out is, hey, I have a 680 score. Well, then when you turn around and go right to the financial institution, they pull a score and say you may have a lower score or maybe a higher score than that. Well, that reason is you have two different data point systems. You have what's called a FICO score, meaning Fair Isaac Corporation, and then you have a Vantage score, meaning it's another different algorithm that is not, conducive to the FICO score, right? So both of them have the same amount of data points. The score ranges from 300 to 850. Now that's a 550 point swing either way, right? So for the most time, we just understand, hey, my credit score went up, it went down. I don't know why. I'm not sure exactly what's going on. I pay my bills on time, and I don't know exactly why the things is happening, right? And I get this all the time because a lot of my clients come to me and they have different types of concerns, different types of goals. And again, we all make mistakes. We may have to file bankruptcy. We may not been able to pay bills on time, or we would never understood about like credit or anything like that, or how to use it properly. And now, we're making a mistake, right? So I actually want to tell a story real quick. So I used to watch this show called The Christmas, right? It's with Danny Glover, Monique, and it's about a Christmas tale where it's Christmas time. He has all his family come to his house. And when they come to his house, he has the kids, he has the grandkids, and Monique is his sister-in-law, right? Well, this particular year, the mom passed away, and one of the things that he really wanted to do was to be able to make this sweet potato pie, right? So you have all the ingredients there. You got your eggs, you got your potatoes, you got your nutmeg, your sugar, your brown sugar. You got all these ingredients that he just knows that goes in there, but he don't really know what the portion sizes is. So every single day for about 2 weeks, he goes in and he tries to make this sweet potato pie. And first times it happens, it burns. The second time it happens, it don't have enough sugar in it. The third time it happens, something else happened to it. So over and over again, and then he's trying to tell his nieces and daughters and everybody things to help him make this sweet potato pie. So he tastes it. It just don't taste right. You ever had that situation where, you go to grandma's house and you know how her stuff made, and then your mom make it and it don't taste like grandma's, right? It don't taste like grandma's, but you want to figure out how you make it like grandma. And she just does it just without thinking, right? Well, she has the recipe. She has what's called the blueprint to make that sweet potato pie. So once he found the recipe and the blueprint, after weeks and weeks of trying, he was able to finally put the ingredients together. He was finally be able to put enough nutmeg, enough eggs, how many eggs to put in there, what temperature to bake it on, how's it going to come out once it gets done. And then at the end of the movie, everybody shared their slice of sweet potato pie just like Mama made. So in instance, it was a representation of her being there with the whole family when she was passing. But to bring the point home, it's just like having this credit report, right? So we have everything in the components of the credit report. You just know that, hey, I got a bad score, I got a good score, but you don't know why you have a bad score. You don't know why you have a good score. You just know that your score goes up. I pay my bill on time. I do everything that I'm supposed to do, but I don't really have a blueprint understanding of why. So this is what I'm trying to say is what we need to have is a specific blueprint to say, this is why that you have the lower score. This is what makes up a different score. And when you have that blueprint, now you can manipulate your credit score at any given point. So let me give you the blueprint, right? So first things first, right? So there are 5 factors that makes up the credit report, right? So you have what's called payment history, right? That tells you how many times you pay. Everybody tells you pay your bills on time, right? That's 35% of your score. Just payment history back there, right? And then you have what's called a utilization on that score. And what happens is the utilization, meaning how much credit that you have, how much limit do you use, right? And people say use 30% and things like that. Well, it fluctuates based on how much credit limit that you have and also how much you use, right? So for instance, if I have a $3,000 credit card and I only use $300, well, I'm at a 10% utilization. Well, if I use a $3,000 credit card and then I have a $1,500 balance on there, then I'm actually using 50%. And that's why your score takes a dramatic hit between that 15% to that 10%. Okay. So once we understand just those 2 factors, that gives you 65% of your score. 30% for your utilization, 35% from your payment history. Now, you already halfway there now that you understand that if I pay my bills on time and I manage my utilization, then I can actually have close to where I need to go. Okay, so now charge-offs, collections, bad debt, things like that already can be fixed. They can be fixed, they can be changed, and things like that, right? So the third thing is inquiries, right? That's 10% of your score. Just like how many times people are pulling your report, those are the inquiries that shows up every time. If it's a hard inquiry, if it's a soft inquiry, and based on the 3 bureaus, TransUnion, Equifax, and Experian, it determines what your score looks like. And you ever wonder why your score look different on all 3 of them? Because they really don't really share with each other. They're really competitive against each other, right? So again, now we know that if we just have our payment history, which is 35%, our utilization, which is 30%, 10% is for the inquiries, then you have 15% for, the history of payment, like how many years that you've been in history. So meaning, say if I have a card that's been 10 years old, now I have a 10-year-old history. The more history you have, the better your score be as well, okay? And then you have what's called mixed use credit, right? Meaning that you have loans, student loans, you have card loans, you have credit cards, you have any type of other non-revolving credit, then that will make up those 5 factors. Okay, so now we understand what we have the recipe, the blueprint now, and now that we can actually understand what the blueprint is, now we can manipulate that thing. So the thing that you can really control is your payment history, making sure that we make payments, even if it's the minimum payment, we can actually make those payments on time every single month. Then we can actually go and manipulate our utilization based on how much we can actually do, right? And then we can actually say, I'm not going to utilize that many credit cards at the time if my inquiries are too high, right? You want to be within around 2 to 5 inquiries in a given 12-month period, because they fall off every 2 years, right? So every 12 months or so, they start falling off, and it's not weighing as heavily on your report. And that way you can actually focus on your mixed use, how much credit you have and how much your payment history are you using, right? So that actually comes between the 550 points that we talked about before, the 300 and the 850, okay? So now if I say my credit score today is 650, but my utilization today is 50%. Well, two things I can do with that. I can reduce my utilization easily by either paying down the card or having another card with a higher limit, right? So now I increase the limit and reduce the actual percentage of the utilization, meaning if I had a $3,000 card and I actually add a $10,000 card, now my utilization goes from 50% down to 3%. And see, your score jumps up just like that, right? So guys, I'm just kind of giving you an overview of some of those concepts so that you can actually understand how to be able to manipulate it. And now once you understand how to do that, you know exactly what we call and hide our utilization, right? Because again, your reports only report once a month, right? Once a month. So now if I know my due date and my statement date, I know one day I need to pay it and one day I can actually spend it again. Let me give you an example. If I actually wanted to hide my utilization from the banks and anybody in the institution, what I can do is simple. I can say, okay, if I have that balance of $3,000 and I had spent $1,500 and my due date is on the first of the month and my statement doesn't come out to the 5th, well, I'm gonna pay the $1,500 right on the 1st. Wait to the 6th. Right, wait till the day after it reports to the bureau, and I can spend the whole $3,000, and now I just hit the utilization, and now as long as I pay it back the next month, it's not showing on my report that I used $3,000 on the 6th of the month. You see what I'm saying? So that is something that those are some of the tricks and the things that I kind of teach some of my advanced students that actually understand and try to, hey, I need a little bit of money to start this business. I need a little bit of money to get to the next month or build or put myself in a position where I can leverage my money to be able to do these things, right? So those are some of the concepts that I actually like to explain to you. But on the next episode, guys, we actually going to go and dive in. It's a little bit more advanced strategies, but I wanted to get the basic down first. I wanted you to be able to understand how to be able to read a report, what actually makes up the report, and be able to actually position ourselves now to go from where we are to where we want to be, right? Because one thing for sure is we have control over ourselves, right? So our credit report is our report card to the world, like we had in school, to tell everybody how good we do on our personal finances and our credit. If we mess that up, that means our word is nothing, right? So our word is all we have. We can have millions and millions of dollars in access to only by being able to sign off a document, right? If you want to learn how to be able to get 0% interest credit cards with just a signature, right? $10,000, $15,000, $20,000 on your personal credit with just a signature. We don't have to go into the bank and actually fill out tax returns. You ain't got to put in co-signers, down payments. Only thing you're doing is just fixing your particular credit. And now when you know how to do this, guess what? You can start helping other people. And now you can start making income for this. And now you can shift your being able to have issues with it to now, like I did when I went bankrupt, back in 2009, I didn't know anything about this. Then I started my journey to focus on how to build and sustain credit. So now you can get, like me, over $250,000 worth of asset credit. And now with that, you can start creating business. You got funding, right? So it's not a lack of funding that we have. It's a lack of education about how to get to the funding is what we have the capacity to have. Once we have the education, the money is always there, right? So what's the difference between a billionaire, millionaire, and a broke person? Is the amount of education and action that they be able to take from applying what is their knowledge. Now, you also have people that got the knowledge and don't apply it either, too. So that's a whole other thing for another episode. So stay tuned to the next episode, guys, and I'll actually see you on the next conversation. Like, comment, and subscribe to our channels. Doniel Lovely on Instagram, Doniel Lovely on Facebook, Doniel Lovely on YouTube, right? And we'll see you at the top and at the bank and at the beach.